Hello and welcome to the National Center for the Middle Market Q4 Middle Market Update. My name is Doug Farren. I'm the Managing Director of the National Center for the Middle Market. Pleased to be with you today to go through the results of our latest semi-annual survey of 1,000 mid-sized companies across the U.S. Got a lot to cover today. And no, I am not inside a snowy Ohio Stadium or horseshoe, but certainly does reflect the weather around here. So I'm going to go ahead and get started going through, like I said, our latest data. Please feel free to use the Q&A functionality. If you have a question, we'll try to get to as many of those as we can over the next 45 minutes or so as we cover off on the information. And always encourage those who desire more information to reach out to us at the center. We're always happy to provide that. So if you're new to our webinars or don't know much about the National Center for the Middle Market, we are a center of excellence located at the Fisher College of Business. We are a partnership with Chubb, and we exist to help mid-sized companies. That's been our mission ever since we launched in the fall of 2011. We do that through research. We do that through outreach and engagement with a number of partners around the country. We do that through education, which includes our students as well as executives. And we also have done policy education as well. So that's really what we're all about. Just as a reminder, our definition of the middle market, we look at companies with annual revenues between 10 million and $1 billion. It's essentially the middle third of the US economy. It's about 200,000 businesses, accounting for 1/3 of private sector jobs and GDP. These companies have been in business on average about 31 or so years, and upwards of 90% of them are privately held. So our agenda for today, we're going to cover the results of the data in terms of middle market company performance and sentiment. We'll talk to you specifically about some of the COVID pulse information we've been gathering since March of last year. And we'll also look at some highlights from diversity and inclusion questions that we included in this latest survey. So let's hop right into it. So the what? So to give you a little reminder of our research agenda around the COVID-19 pandemic, we started way back in late March of 2020, shortly after the World Health Organization declared COVID a global pandemic. We quickly went out within several weeks and were able to gather what we called our initial pulse check with 260 executives who had taken our December 2019 survey. So what that allowed us to do was kind of get the sentiment heading into 2020 and then shortly after this crisis hit. In June of 2020, we went back for our second quarter indicator, and this time fielded very similar questions to 1,000 companies as part of our normal survey process. We repeated, like I said, many of the questions, and we wanted to be able to compare how things had changed. Now, as a third installment in that series, we fielded, again, questions about the COVID-19 pandemic in this latest survey, which was fielded between December 1st and roughly through Christmas, so the month of December. Fresh data, new data, and excited to share that with everyone today. So what's going on with mid-sized companies? Well, clearly the results or the seriousness of COVID has yet to wane. In December, nearly 4 out of every 10 companies in the middle market said that COVID-19 would be catastrophic for their business over the next 6 months. Now, compared to the last time we surveyed in June, you can see it's come down slightly from 46%. And back in March, almost a year ago now, 75% of companies, again, smaller sample size, but 75% of respondents at that point, with all the uncertainty that was happening, all the shutting down of businesses and states and society in general, there was just a lot of uncertainty about what the coming months would hold. So we're seeing gradual improvement with that. Keep in mind, this data was collected, as I said earlier, in December when the news of the vaccines and the final approval and rollout of initial vaccines were happening. So that's certainly not a end-all solution, as we all know, but should go a long way in helping not only businesses get back to business, but customers feeling better about going back out. Performance. So where does the middle market stand? This chart really summarizes a lot of the key indicators that we've been tracking over the last 9+ years. You can see middle market companies on average still reporting declines in their revenue. So for the past 12 months, essentially the year 2020, annual revenues in the middle market declined by 1.2%. Similarly, a negative impact in employment, decline of 2.2% over the previous years. Now, as bad as those numbers are, and again, we had not seen negative growth in either of these metrics in about 34 of these surveys, I believe, until we got to Q2 of 2020 when we saw the first hits. But look at our comparisons to the large business. So S&P 500, which we use as a proxy there, and the revenue growth, minus 5.5%. And then for employment, we use ADP monthly employment reporting as a proxy for both small businesses and large businesses. And you can see they took much bigger hits in terms of their average employment declines. The good news, there's a lot of cautious optimism out there as we think about the coming months. Middle market leaders are projecting over 4% revenue growth and 2.3% employment growth. Now, if the trend holds true, and everything's kind of been thrown out the window in the last 10 months, but traditionally we've seen that number be under forecasted. In other words, the predictions have been very conservative, and in many cases, the middle market delivers numbers that are higher than the 12-month forecast. Remains to be seen, and we'll be keeping a close eye on that. Capital investment. So we asked companies if they had an additional dollar of revenue, how would they spend that dollar? And just over 50% are saying they would invest. The historical average has been around 65 to 70%. I think our all-time high is just over 70% investing. So this is a trend that we've seen now for the last 3 or 4 surveys, not specifically COVID related, but certainly impacts on the amount of cash being invested back into the business. And then confidence at various levels of the economy, global, national, and then of course local, which would be within a city, a region, which is where in fact most middle market companies do their business, continue to lag. And I'll have a trend chart here in a moment where you can see where these numbers stack up. So all in all, not great, but hopeful for the future. Here's the revenue trend. So we'll take a look at the trend since the beginning of 2013, almost as back as far as the MMI has been in existence. And you can see the precipitous fall that took place in the second quarter of 2020, actually, down near 5% decline. The news has gotten a little better, as I said earlier, minus 1.2%. And that line is pretty much trending with what the S&P is doing, but you can see the decline for the S&P has been much greater at minus 5.5%. Of course, this story, you have to dig deeper and look at industry by industry, because not all industries have been impacted. We've seen, certainly some positive stories. If you take a look here in the last year, in 2020, services and healthcare were actually reporting, not the strongest revenue growth numbers we've ever seen, but positive, almost 3% in services, and a little over 2% in healthcare, not surprisingly, given everything that's been going on. Where on the flip side, the biggest hits have come in the retail trade, which would include restaurants, as well as construction. As we think about the next 12 months, certainly bigger increases expected in services as well as healthcare, with less optimism forecasted top line growth for retail and construction. Obviously, still a lot of uncertainty around the different types of regulations that are in place and capacity issues, certainly as we hear about bars, restaurants, and the like. Now, if we take a look at employment, again, this trend line goes back to 2014. You can see that traditionally the middle market has always outpaced. In fact, without a single quarter or semi-annual check-in, has the middle market revenue growth not outpaced large and small. But let's just be honest, the entire employment outlook took a hit during 2020. And we're starting to see that bounce back just as we did in revenues in this latest survey, with employment declines averaging just over 2%, while small and large business were much larger at minus 5.1 and minus 8.2% respectively. Let's take a look at the industries again. No surprise, just as we saw in revenues, the biggest hits for 2020 were on the retail trade side and the construction side, which saw the largest employment declines, followed not too far away by manufacturing and the wholesale trade industries. But similarly to the growth, we saw positive employment growth in services and healthcare. So tracking very closely to the revenue growth patterns that we saw. Projecting for the year ahead, everyone except financial services projecting a positive employment growth. So that certainly bodes well. As we know, the middle market drives a lot of the long-term sustainable jobs in the US. In fact, during our last big crisis, the financial crisis of 2007 to 2009, while big businesses were shedding jobs, the middle market added well over 2 million jobs. So what that means is this is an important sector. We need to be watching these industries, and we need to be supporting the middle market as they bounce back in the ways that they feel are most appropriate. Confidence, showed these numbers to the far right earlier, but we are coming off what was a record low rate of confidence, as you can see, noted by the call out there back from the summer, where all three levels, so traditionally the global confidence, which is that lowest, that purple line, is always lowest, just because the global economy is something that seems very far away. Not many companies can do a whole lot about that. The US economy, obviously of more importance, closer to home. And then the local economy is what's going on in their own backyard. So this pattern is very familiar to us. And as we can see, there is a little bit of an increase on all three of those levels coming out of the summer and into the end of the year, but still trending way below where we've seen at least over the last 4 years. Let's look a little bit closer at the investment. So again, that question that we ask is, what would you do with an extra dollar of revenue? And you can see a year ago, that pie chart on the left, 30% of businesses were saying that they would hold as cash. Now, what were they going to do with the things that they were investing in? Well, the biggest one at that time was IT, followed closely by CapEx, plant and equipment, and then adding more personnel via HR. Fast forward 1 year, the save number is at 43%. We can clearly see that IT, for many different reasons, most of them out of necessity, continues to be the number one area for investment, still followed by plant and equipment. This trend for saving cash has been something that has actually been kind of pre-COVID. As we were getting toward the latter half of 2019, we saw this save number start to go up quite a bit. highlighted by that high of almost 50% in the second quarter of 2020. As I just mentioned, we're at 43% now. But again, this is a good indicator of uncertainty and cautiousness about what middle market leaders are going to do in terms of how they view their business. Another reflection of that, this is a slightly different question, but plans for expansion. So we ask, how likely or extremely likely companies are in terms of taking on various expansions for their businesses. These bar charts represent 4 surveys, so 3Q and 4Q 2019, and then 2Q and 4Q of 2020. You can see everything has dropped, most notably at the far left, adding a new plant facility, making a large construction capital investment. That is way down to about 15% of companies. Similarly, entering a new domestic market is quite a bit lower than we saw even 1 year ago, whereas entering an international market is about the same as is making an acquisition. So those two on the right have been less impacted by our current economic environment. So now what? Let's look ahead a little bit, take a look at some of the forecast numbers. So in addition to collecting self-reported data from these financial decision makers, we also ask them to project out. It's a very difficult thing to do these days, given a lot of the lingering uncertainty, not knowing, when waves will hit us again and things will be forced to go backwards. But at the time of the survey, again, which was throughout the month of December, this is what financial decision makers were telling us. For the next 12 months, they were expecting an average revenue growth just over 4%. Now you can see going back to various other end of year forecasts, this is running a little bit below average, but certainly much improved from the second quarter when the projection was only down at about 2%. So we've doubled that, haven't quite hit the historic average yet, but certainly trending in the right direction. And as I said earlier, a lot of times these numbers tend to be very conservative, but given everything that's happened and the hit that a lot of businesses have taken, it remains to be seen whether these are conservative or maybe cautiously optimistic. Here's the employment growth forecast. So very similarly, going back over previous end of year surveys, you can see the historical average, almost 3% on the forecast. We're below that at 2.3%, but much improved from the second quarter when a negative employment growth or a decline in employment was actually forecasted for the next 12 months. So this situation has improved. Obviously, as we saw in some of the sector figures, it's going to vary from industry to industry, but another important number to keep an eye on as to whether this is cautiously optimistic or baked with lots of uncertainty. Some of the COVID specific questions, we've been tracking a lot of different things in terms of status of people at work and time needed to bounce back. This is a very interesting comparison of the 3 different pulse surveys that we've done. As I mentioned, we started in March, we followed up in June, and then followed up again here in the December survey. I'm going to focus on the far to left numbers. So these were how much time it would take to get back to full capacity once the pandemic is under control. In March, as we could see, for almost 40% of the companies thought it'd be a very quick return, 1 month or less. Compare that to the far right there of the chart. Just under 20% thought it would be a significantly longer return of 7 months to perhaps even a year or more. When we got to June, I think the stark realization started to hit a lot of these leaders and executives that this is going to take a lot longer, right? That we were dealing with government mandated shutdowns that varied state by state, certain industries being impacted more so than others. And the net impact was, less than a quarter of the companies thought it then would be immediate, and a huge increase to over 40% thought it would be longer. Well, that pendulum has swung once more, where we see that, the optimism now is trending toward a quicker recovery, with still a quarter of the companies thinking it's going to take much, much longer for them to get back to full capacity. The status of the workforce. So we wanted to find out exactly where people were working. Are they still, forced to stay at home, either by mandate or by choice? Are they back to the shop floor or the office? So this graph kind of breaks that down. So as you can see, 4 out of 10 middle market employees are fully back to work. They're going into the office. They're back to wherever it is that isn't home. While another just under 30% are in some form of a phased return. And of that 28%, over 50% have actually returned. So that's progressing. A smaller portion, just about 20%, are waiting. They're going to see what happens with the vaccines. They're going to see treatments. They're going to monitor numbers, and they're going to wait, hold off. And then, interestingly, we've got a very small percentage, about 2%, that basically are saying they'll never go back. They have transitioned to a fully virtual company, most likely in some type of technology or services industry. We have the data to look into the industries of these respondents, but basically this has become an accelerant to a fully virtual company, which is very interesting to watch as well. So what business activities are middle market companies struggling with? We've updated this chart, which we first shared last quarter, basically taking, so the math here is taking the difference between the negative impact, which is the third column, and the positive impact of the first column for each of these business initiatives, which you can see listed on the left-hand side, starting with revenue, supply chain growth initiatives, and so forth. The biggest hit, the biggest negative, the net negative, continues to be in supply chain. So, worrying about other companies being able to provide inputs, raw materials, payment issues, data issues, disruption, lots of concerns there. I believe revenue was our biggest in the second quarter. You can still see that that's a pretty high net negative impact at -18, along with growth initiatives. So the top three kind of remain there, business operations as well. And then in the far bottom, you see the only positive here is digital transformation. So the net positive impact from COVID on companies in the middle market and their own digital journey is net positive. And as I mentioned a little bit earlier, some of that's out of necessity. So you've got workers still at home, which has caused, perhaps some hardware and software considerations, also looking at cybersecurity, also looking at different platforms to be able to do things as productively as possible and as efficiently as possible. So that has pulled forward some investment. As we saw earlier, the sentiment for investing in IT, the need for digital transformation of the company. So that is the one area that is going to be also interesting to watch as we go through 2021. About 2 years ago, we started as the NCMM started looking at this concept of digital transformation. We actually have a research paper out there on our site about the case for digital transformation. If you want to look at this a little more closely, I would encourage you to go check out that paper. We've got a nice framework in there that talks about the different areas of the enterprise that make up, majority of the primary functions and some of the things that they can be doing in each of those functions in terms of their own journeys. So something that, again, we'll continue to watch as we go through this year. Another area we track risk. This is something that, particularly with our relationship with Chubb, we've added in over the last, probably 2 years or so, continuing to refine, but we measured how COVID has impacted executives' appetite for taking on risk. No big shocker here. 47% have said they're either much more or slightly more risk averse due to what they've gone through over the last 10 months. Again, probably not a lot of companies in their, risk planning, if they have a risk plan, probably looking at natural disasters, work disruptions, maybe cyber breaches, things of that nature, pandemics, certainly of this nature that come along once every 100 years are, probably weren't built into the plan. So there's going to be, skittishness and hesitancy right now. We'll continue to see if this subsides over time, but again, not a big surprise here. Yeah, and then this is kind of builds on what my last comment there about the exposures of business preparedness. So, what you're seeing here are the percentage of companies that felt they were completely or very well prepared for different events. The common ones being weather, power outages, a lot of those natural or weather-induced kind of disruptions, and cyberware, ransom attacks, these types of things. Pandemic, you can see much lower on the list, as is government mandated shutdown, which was related to this, and a lot of the civil unrest that we saw in the spring and the summer months are ranked very low on the list. So, the message here: companies probably thinking about this a lot more, maybe going back to the drawing board and thinking about how they can be a little bit better prepared both before, during, and after these events. So my last subject, diversity and inclusion, has becoming more and more important for businesses. A topic that's for the Fortune 500 has been pretty front and center for a while. And like I said, given everything that's been going on in our society and the country, we felt it was important to get some insight into how middle market companies view this topic, and really thinking about what they're doing today. What are some of the challenges? So I'm going to share some of the highlights of that with you. And again, this is something that's important for Fisher College of Business. So we've got a number of initiatives going on within the college. And this is, something that we're also even exploring, maybe some type of a potential program or training that we can incorporate into our executive education as we'll see here in the data. There's some opportunity within middle market companies. So let's just start with our first kind of insight around the importance. No surprise, when we ask, how important are diversity and inclusion to your company culture? 60%, almost 60% said it was either extremely or very important. That was consistent across the board. So we've got, 3 different categories of mid-sized companies. We've got our lower middle market, our core middle market, and our upper middle market. You can see those 3 to the right, pretty consistent across the board. Although our core middle market are saying it's extremely important to them, maybe a little bit more so than the upper middle market. And then you can also see consistently just over half of the companies in all of the middle market and then all 3 of the segments are stating that diversity and inclusion are stated as part of their company values. So this tells us that, yes, it's something that they think about. We always like to, add the caveat that these are self-reported. Yes, it is possible that we're not asking this of the right person within the company. However, we feel like it's at least a starting point to get some of this insight, and hopefully people are being honest here and telling us what's really going on rather than how they perceive it in terms of some of their own maybe implicit bias of their performance. So some other highlights. We wanted to know who is responsible for DE&I. No big surprise, 30% have an HR leader that, in addition to all the other functions within the company, they're overseeing DE&I. But also another 30% or so are saying this is a shared responsibility among the executive team, with another 28% saying that the CEO, founder, owner, primary person running the business also has primary oversight for DE&I. No big shock to us, but only 5% of our respondents actually have a position designated for a DE&I officer or director. So someone whose sole responsibility is to oversee these types of initiatives within their company. On the right-hand side, we've got just basically a list of, and wanted to see how many companies are participating in some of these strategies. So clearly about 2/3 have anti-discrimination policies, just about half focus on gender equity and pay equity. And then you can see kind of the rest of the list there. So, pretty broad coverage, although as you start to get, past maternity and paternity leave, you can see it drop off pretty significantly in terms of some of the other programs that are being used today. So this slide is probably mislabeled. These aren't the obstacles. These are actually access to different types of training. And again, we've got different color bars for the total middle market, lower, middle, and upper middle market. You can see here that on the far left, significant number of companies are reporting that their employees have access to different types of training on discrimination and harassment. That 72% number, you can see that the lower middle market, surprisingly, actually leads in not only this, but every category in terms of the percentages, which is a bit surprising in the fact that these companies are going to behave more like startups given their size. They might have much fewer resources, fewer headcount, which means maybe less HR bandwidth and capability and able to run these things. But that's about the big standout here is the lower middle market appears to be leading the way across all these categories, including diversity and inclusion training, safe zone training, leadership development more broadly. And then the last box, unconscious bias training, is one of the least offered. You can see about 50% of the middle market has some type of offering for their employees. And then the obstacles. So what are the big issues? What would be the stumbling blocks for middle market companies as they think about diversity and inclusion within their own organization? So 40% are saying both financial resources as well as the own internal knowledge and capability are presenting either major or minor obstacles for them. Organizational inertia, having a business case. These are all some of the other reasons that were stated. But again, middle market companies are often stretched pretty thin, particularly from a leadership standpoint. So if you think back to that pie chart earlier, and you've got an executive team or a CEO who's not only thinking about the strategy of the business, long-term growth initiatives, overseeing the day-to-day, but then they're also adding this DE&I on top, could very well lead to, kind of a check the box effort, so to speak. Not saying that's the case, but certainly it's being acknowledged here as one of the big obstacles. Financial resources too. I mean, just, having the training is one thing, but, constantly reinforcing that, whether it be through workshops, whether it be through diverse project teams, whether it be through doing things in the community. We have several examples of programs within Fisher College that bring in company executives. They work together to learn certain things, but a lot of times they're working on projects that help the community. And that diversity and, maybe being exposed to parts of their own community that they're not as familiar with also leads to more unlocking and awareness of what some of these, big issues are in our society. So I think this is only going to, continue to grow over time in terms of the interest in this topic. And like I said, we're going to be watching this as we go. So let's summarize some of the big takeaways from this update. So first, the middle market appears to have entered now into this, what I'll call a second phase of recovery, right? So everything kind of hit the fan in March. Everybody scrambled to shut down businesses, set up home offices, basically thinking this might be a 2 to 3 month issue. In fact, I remember our own team at the center, we took various bets, a week or two into being from home. And I think the farthest out might have been, Memorial Day of 2020. And certainly now it looks like it might be past Memorial Day 2021. So none of us were close in that regard. So bottom line, everything falls off. July comes around. Again, this is in sequence with our pulse from the second quarter. Businesses start to reopen. You see states start to reopen. There's guidance coming out from different organizations on how to create a healthy workplace. We collected some data at that time that said that was kind of top of mind for companies was, how do I protect my employees and how do I protect my customers? And so the realization started to hit that, hey, this is going to be around for a while. Maybe this isn't the type of, V-shaped recovery that many of us had hoped for, but could be a much, much longer event. And then we get to the end of the year, and certainly, as we saw in a lot of this data, the recovery has not been universal by industry. But with the promise of these vaccines continuing to roll out, albeit at a somewhat of a clumsy pace here at the beginning, but hopefully that will continue to improve over time, become more efficient, get more shots in arms, and then people will be less hesitant, and our economy can start to pick up in many various ways. Supply chain, and then also challenges around customer retention and engagement. I didn't have a slide specifically on the short-term challenges that leaders are facing, but one of the things they've been calling out to us is now that they've maybe figured out some of the PPE things and how they can keep their conference rooms and their offices a little bit more safe, the challenge now becomes, how the heck do I keep engaged with my customer? How do I not lose that relationship I had because I'm not going to live events? We don't have trade shows anymore, at least for the foreseeable future. Can't make site visits in a lot of cases. So what are some of the creative and innovative tools and techniques that you can do to drive that engagement? As we saw, digital transformation is the initiative within a lot of businesses that is continuing to gain traction. As I said, a lot of that being out of necessity, given the work environment. COVID has just accelerated things that companies may have been thinking about, talking about, but now they're actually forced to do it. And then finally, we looked at diversity and inclusion being important to most middle market companies. Yet, just like a lot of other things, they can at time lack the financial resources as well as the bandwidth and internal knowledge to be able to manage that type of initiative across their company effectively. So, uh, that being said, I think the word is, for 2021, cautious optimism. We have been talking with middle market companies who, that I think pivot has been overused quite a bit because a lot of people have had to pivot, but companies have just kind of figured out, what can they do to claw back some revenue? What can they do to manage their working capital and cash, become as efficient as possible with their expenses if they're not able to get back to maybe pre-pandemic revenue levels? How do they continue to maintain profitability in what could be a fairly ongoing challenging environment? But there is cautious optimism. There's a hope that as we get toward the latter half of the year, which we'll see as we take our next survey in June of this year, we'll find out more about how that trend is going and how companies are doing. But we need the middle market. It's critically important, because if there's one thing that we've learned at the center over the almost 10 years we've been around, is that this segment is the bedrock of our economy and we need it to do well. So we're going to keep watching it. We're going to keep supporting these businesses. And again, if you have questions, please feel free to send those in the Q&A. If we don't get to them immediately during the webinar today, we'll try to follow up with as many of those as possible after the event. So with that, I would encourage you to go out to our site. If you go to the Middle Market Indicator landing page, you can download the full MMI report. We've also have lots of other information there, industry infographics. We have historical data. So a lot of the raw data from not only this survey, but prior surveys, if you're interested in seeing that. And then just a wealth of other information. Our COVID Pulse 3.0, which was released in middle of January, is available as well. And you can see a lot of this trending information as we compare the 3 different surveys. So I want to thank you for joining us today. I want to thank you for your interest in the middle market and the National Center for the Middle Market. Once again, my name is Doug Farren. I'm the managing director of the center. If you want to reach me directly, I probably should have put this on this slide. My email address is my last name, F as in Frank, ARREN, .6 @osu.edu. So I'd be happy to answer any follow-up questions that way, provide any additional information if we can do so. And want to thank you again for your time and hope you have a great rest of your day. Thanks a lot for joining.